Hi guys, Max here, and this is, of course, your daily market update for yesterday, the 4th of July. Now, it being the 4th of July, it was Independence Day in America. It's the day where you celebrate getting away from me and my kind, and so markets were closed over in the US. I hope you all had a good day, maybe some good fireworks, but the rest of the world, we still had markets open because we aren't quite so lucky. So what did we really see happen with the markets? Well, firstly, we'll talk just a little bit about futures on the US markets because, of course, those sort of contracts do trade constantly. The S&P 500 was down by about 0.4%. Futures on the Dow Jones was down by 0.3%. And then futures on the Nasdaq was down by 0.5% as well. So not a stellar day for American equities, even as markets were closed. In the rest of the world, though, it was actually a fair bit better, as you can see from this heat map behind us. In the rest of the Americas, relatively strong. In Europe, quite strong. And in Asia, quite strong too. The FTSE 100 rose by 1.2%. And the Stock 600, well, that rose by 0.5% as well. And then the MSCI World Index, so every stock in the world combined, rose by about 0.3%. Now, the dollar didn't really move much, and so its spot index was actually not really changed at all. The euro rose very slightly and is sitting at about $1.04 right now. The pound also rose very slightly, about 0.1%, and is sitting at $1.21. And then the yen fell by 0.4%, back down to 136 yen per dollar. Now, in regards to foreign currencies, we've actually just seen euro Swiss franc parity, where they're basically worth as much as each other. Now, earlier on into the year, and the euro was far stronger at 1.15 to the franc, but the euro has been consistently losing value compared to the dollar and the franc, as has the pound as well, and most other foreign currencies actually. But we've finally just seen the euro switch with the Swiss franc, and I think actually as we speak right now, the franc is a little bit stronger. Now, in fixed income asset markets, in the bond markets, again, US bonds weren't trading because markets were closed, but the German 10-year yield rose by 10 basis points to 1.33%, and the British 10-year yield rose by 11 basis points to 2.19%. So again, this idea that actually maybe bonds aren't the safest of investments right now, as inflation and interest rate hikes are still likely coming into the future. Finally, for commodities then, we saw oil prices rise up again. WTI crude is back above $111 a barrel, and Brent crude is back at $113 a barrel. So that downwards movement that we saw over the last couple of weeks, well, we are now starting to see it reverse. Finally then, gold actually made some gains for the day. The first and the largest gain we've seen for gold for about 2 weeks. It rose by about 0.5%, and it is just a touch below $1,800 an ounce right now. I think 1,798 as I speak. Now, as for the crypto markets then, what did we see over there? Well, we saw a small rally that followed some small declines over the weekend. Bitcoin is just below $20,000, as you can see. Ethereum just above $1,100. Really, the crypto market is still very weak. This graph here may be very green, but if you go back a month or two and tell people that Bitcoin would be below $20,000, you'd probably be laughed out of the room. Altcoins as well performed well for the day, but over the last month or week or any sustained time period, again, altcoins are performing really poorly. Just the whole crypto market is as a whole. Now, what has been driving markets over the last couple of days? Well, firstly, it seems that actually fears are moving away from just inflation on their own fears and just from quantitative tightening and interest rates, and people are really starting to get worried about the idea that we're entering a recession, or that maybe we're already in a recession. Obviously, I've been saying this for quite a long time now, so you won't be surprised to hear this, but finally, pundits on Bloomberg, on CNBC, on CNN Business, they're starting to move in the same direction as well, and it seems like more and more institutions are coming out and saying that actually maybe recessions are here. The Italian debt crisis is continuing to get worse as well. Debt is getting very expensive there. Bond yields are rising really quite damn high, and so it's going to be very difficult for not only the government to service their debts, but for a lot of Italian companies as well. They're sort of stuck in a really awful situation because the European Central Bank wants to hike rates, or at least we think they want to hike rates, but when they do that, it sends bond prices higher, and if they don't do that, well, then inflation maintains at its really high levels. So there's a lot of chaos in Europe. And there's also quite a lot of chaos in China. You can see from this article here that there is another COVID flare-up, and there are worries here that that region, the Yangtze Delta, which includes Shanghai, Nanjing, and like 10 other cities with more than 1 million people in it, well, there's a lot of COVID going around, and there are fears that lockdowns are going to come back to China as well. There's also been another update regarding a Chinese real estate company going under. They just failed to make a payment on a $1 billion bond, which is obviously not good news at all. There is just a whole load of issues in China right now, so I will put out a full video on that later for you all. Now, out of Israel, we had their interest rate decision for the last month, and they've chosen another 50 basis point rate hike to try and curb the insane levels of inflation we're seeing all over the place. Actually, insane isn't a fair word to use regarding Israel itself, because actually inflation is only at 4.1% because they were just a fair bit more conservative with their quantitative easing throughout the COVID pandemic. And so inflation hasn't been quite as poor. They're also not quite as affected as the rest of mainland Europe, for instance, in regards to the energy price crisis that we're seeing. But nonetheless, the Bank of Israel has hiked another 50 basis points, so their interest rate is now set at 1.25%. This is their third interest rate hike in a row and the largest one we've seen so far, and people are expecting this to continue as well. Now, really, we're seeing this same sort of thing all over the place. It isn't just the Federal Reserve that's hiking interest rates. We have smaller central banks all over the world doing the exact same thing, also trying to curb inflation in their countries. Across the rest of Europe, of course, the ECB hasn't started yet, but they are going to be. The Bank of England has. In Canada and Australia, their central banks have been hiking too. Really, we're watching a worldwide tightening event start. Now, moving on to some corporate news, we first have some problems regarding TikTok and their parent company ByteDance, which is a little bit of a surprise because it's been incredibly successful over the last 5 years. Probably one of the most, if not the most successful company over the last 5 years. Now, TikTok has always had a problem, and that's that it's actually quite a difficult platform, a difficult social media to monetize because it's full of short form videos. So it's quite difficult to put in unobtrusive adverts. Now, to try and get around this issue, to help TikTok themselves monetize the platform and to help their creators monetize, they came up with the idea of a TikTok shop to let people, individual creators, sell products through their systems, through TikTok's logistics, to try and help them monetize to make some more money out of it. Now, it was released in Asia over the last year, and then the first Western market that they introduced it to was here in the UK, where I am. And actually, it seemed quite popular. I personally saw an awful lot of creators trying to use it, but apparently it hasn't been going well behind the scenes at all. Firstly, TikTok has been subsidizing it to a ridiculous degree, making the products on there incredibly cheap. So it is entirely loss-making at the moment. It seems like they're trying to become some kind of weird rival to Amazon and put into place their own logistics systems. The problem is that even Amazon's systems for actually selling products isn't profitable. So of course, TikTok's isn't going to be either. There's also been loads of conflict regarding these logistical systems. Loads of employees went out and quit last week, and so orders just aren't being fulfilled. Apparently, the work culture was absolutely awful. The executive who was running this program in the UK, trying to bring it over to the West, well, he's been fired and replaced with someone else. And TikTok have announced that they're no longer going to be expanding this TikTok shop idea to the rest of Europe and to the US as well because of this failure in the UK. Now, this is quite strange, as I said, because ByteDance has been insanely successful, insanely quickly, and this seems to be their first major hiccup in their plan for world domination. Now, the second company to talk about today in regards to corporate news is, of course, Tesla. It's the end of the second quarter of the year, and so we got their quarterly report regarding their deliveries and production and things like that. And of course, Tesla being Tesla, it's an incredibly popular topic here on YouTube. Now, this was a few days ago here, so I'm a little bit late, but as we're not really a Tesla channel, I don't think that'll be much of a problem. So what did we actually see? Well, it wasn't actually ideal for Tesla. This was the first quarter in about 2 years where they actually didn't see a growth in the number of vehicles they delivered, but they actually saw a fairly large decline. This graph here shows it perfectly. They were hovering around about the 300,000 vehicle mark, actually above that. And over this last quarter, well, they barely cracked 250,000. So quite a significant decline and not good news at all. Now, the silver lining is that there are some fairly obvious reasonings for this fall. Shanghai has been locked down over the last quarter for many weeks, and there's a major Tesla factory there. And so that hurt their production. And that's despite Elon working day and night to try and work with the Chinese Communist Party so he can keep producing his cars. Another silver lining is that actually over June itself, Tesla did post a new record for the number of Teslas produced. So their productive capacity is still expanding on the whole. It's just that problems with specific factories and regulation and government lockdowns are getting in the way a little bit. Unfortunately, I don't think these problems are going to stop anytime soon. Tesla has just announced that their Berlin and their Shanghai factory are both going to need to idle for about 2 weeks and massively slow down production. And then, of course, we have the idea that COVID lockdowns into China are probably going to continue for years because the CCP is still pursuing that zero COVID policy. Frankly, my view on Tesla as a company and an investment remains unchanged. It's a very solid company. It's not even really a disruptor to the car market anymore. It's now as entrenched in people's views of what a car manufacturer is as something like Ford. So it's a very solid company. It's just too expensive to be a solid investment, in my humble opinion. The share price has Tesla priced for absolute perfection, and perfection is very unlikely, as we've just seen over the last quarter, and especially as we move on into a much tighter and harder monetary environment with a worldwide recession seemingly on the brink. Now, the counter to this is, of course, things about, oh, what about energy storage? What about Tesla robots? What about AI and self-driving? Well, frankly, it isn't here yet. It isn't none of those are major revenue sources for Tesla yet, and I don't think they're going to be for a while either. So frankly, if that is your reason for investing in Tesla, then that's more speculation or gambling than investing based on what you actually know. And now the final company we're going to look at today for this video is Uniper, which is an absolutely massive natural gas company in Germany, and it's in an awful lot of trouble for exactly the reasons you would suspect. The war in Ukraine, the Russian invasion, and then the sanctions put into place by the West opposing Russia. They've obviously made the natural gas market very, very volatile, and Uniper is not doing well because of that. They are on the verge of a government bailout to try and save the company. It will probably involve a bunch of loans, some equity sales to the German government itself, or just changing regulations to allow Uniper to charge higher prices for gas and to pass those higher prices on to customers so that they are the ones who actually take the hit. Now, Uniper's share price is down by about 73% from its all-time highs, which is massive. It's down about 52% from 1 month ago and about 30% from last week. Now, that is absolutely awful, but it doesn't sound so awful because we've kind of got used to those kind of falls with companies like DocuSign and Peloton seeing similar awful performances. But this isn't a tech company. This is a well-established, massive natural gas company that really shouldn't be seeing situations like this on a normal basis. Now, is it going to get better or is it going to get worse? Well, it's hard to say. The government bailout would save the company and stop it from actually collapsing, but things aren't exactly going to go well into the short-term future. The business model of this company is based on cheap Russian gas, and cheap Russian gas no longer exists in Europe, and it isn't going to anytime soon. There are also rumors and threats from Russia that they might just cut Europe off from natural gas altogether. It's hard to know if they would actually go through with that. It would also cost Russia money. It would inflict a whole load of pain on the European continent. But the fact that that's even on the table isn't good news. It's bad for Germany as a whole, as well as Uniper, this specific company. Finally then, I thought I'd just all remind you once more to go and check out Stoic Society, our new YouTube channel down below. It's going to be long form, detailed, scripted videos going out on there within about a week or so. I know you'll like it. It's very similar to the type of content I used to post on here all the time. Those deep dives I used to do into things like the Chinese real estate market. So as always, link down below in the comments and the description to go check it out if you want. And thank you all for the support. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to iTrust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join iTrust Capital. Thank you all for watching. Stay stoic. Until next time.